Tuesday, October 28th, 4:42 p.m. New York time. Welcome back, investors, to Winning Wall Street's Money. Tomorrow is the binary event. It's a scheduled event. It's public information. Know it's occurring. 2 p.m. New York time. FOMC meeting. Let's go over the fundamentals first and then the charts. This is the official website for the Federal Reserve. The major one, not the regions. FOMC, Federal Open Market Committee. October 29th. And the last one this year is scheduled December 10th. So the one tomorrow on this website, speculators that are trading have an opinion what the Fed would do. Again, the Fed is one of many agencies for the federal government. One of their mandates is interest rates overnight for the financial institutions. Yes, it does have an impact on yields, but not the primary. So again, Federal Reserve sets interest rates for short term for financial institutions lending between each other. The tomorrow meeting, 29 October, the current rate is 400 to 425. 99.9% are speculating it would be lowered between the range of 375 and 4. And down here, the contrarians are speculating it be left unchanged. Go into the month of December, 90.8% are speculating the rates would be lowered. And the contrarians, 9.2%, do believe it would be lowered for a different amount. Got it? They could be wrong. It's speculations. Let's go to the U.S. Treasury Department, another federal agency. This part of their website shows the yields for fixed income. If you don't know what fixed income is, I'll give you an example. U.S. Treasury Department sells U.S. Treasuries based on the duration. The longer term ones refer to bonds. The ones 10 years are notes, and then there's different names for based on the duration. But again, I tell you, the longer term ones are the bonds, the 10-year ones are the notes, and then there's T-bills. Just like your financial institutions like your bank, they have fixed income products, the money markets, CDs, maybe bonds. So fixed income, they're another financial asset besides equities, aka stocks, besides crypto, besides commodities. Fixed income. Well, the U.S. Treasury Department sells U.S. Treasuries because the federal government, the degenerates that operate in the legislative branch and executive branch, past and present, spend more money than we take in. So we borrow money and we pay interest on that. Who buys these treasuries? Foreign institutions, foreign governments, domestic businesses, domestic financial institutions, individuals. The liquidity is huge. So I'm going to show you the durations. 1 month. The 1.5 month was just added this year. I don't ever recall that in my life. Again, some degenerate in the leadership decided we better add another one in between those. Yeah, in my history, I never saw that. It was added this year. And then there's 2 month, 3 month. Yeah, you're buying these, and every day when the U.S. Treasury's open, they auction them off. The U.S. Treasury knows a certain amount of money they need to raise to continue funding the government above tax revenue being collected. Then they auction these off, and they have to adjust the rates, be able to sell that quantity of a lot of them. So let's go down here. They already closed today, the 28th. So if you bought the 1 month one, and you go to this website, create an account, you buy directly from them. Why would you want to use a bank to do it and charge your fees or a broker? Go directly to them. Get some skin in the game. Own up. If you got time to go to the bank, the time to open a bank account online, why have you not created an account with them? I'm not selling this or getting compensated monetarily. I'm educating you. But still, many people don't own up. So again, the 1 month today, if you bought it, that's the yield to be collecting. Let's go to the 1 year right here. You'd be collecting less locked in 1 year versus the 1 month. And let's go to the 10-year one, which is very correlated to mortgages. 3.99. And let's go to the 30-year. 4.55. Quite a big difference, you notice? From the 10-year. So the real short term, the 1 month, and the higher durations. In between the three. And you can see this for the whole year, the whole month. I could change it all. But it's very interesting for insight to understand what's occurring from the shorter duration to the higher duration. All right, let's go to the next. Give you some more insight. Public information from U.S. courts, official website, bankruptcy filings. Yep. 11.5% bankruptcy filings rise 11.5% over previous year. That's terrible. Double digit. That's really bad. Give you some insight. Here we are. It's every 3 months, this agency updates. So the next one's probably going to be maybe in a few more weeks. Yeah. So 2025, businesses that file bankruptcies. Look at this. Year to date, over 23,000. Higher than all the other years here. Non-businesses, also record-breaking. Higher than the past years. And the total. Really bad. Rising bankruptcies. That's not good for a healthy economy. Nope. Let's go to the next insight. Government spending. Let's update this. Click on spending. There we go. Make sure I'm refresh. $7 trillion plus the federal government has spent. Again, legislative branch, that's the Congress, and the executive branch, that's the president. Legislative branch writes the bills, writes the check, the president signs the check. And they've now broke records on spending. I'll give you an example down here. Compared to federal spending of $6.73 trillion for the same period last year. So for 1 year, compared to now of last year, we've increased the spending $275 billion. That's 4% increase from the prior 12 months of the year. 4% increase. Who can handle that? What kind of individual business could handle a 4% spending unless you're earning income higher to offset that? So again, the U.S. government does not collect enough tax revenue, does not collect enough tariffs is a tax, taxable income, to cover the spending. So again, we sell U.S. treasuries to raise money. If you don't know, the U.S. is carrying a debt. The U.S. carrying a debt is only paying the interest on the debt. just recently, we broke 38 trillion debt. I've been sharing this with you all for a long time. I just shared it recently, the past 30 days, give or take. 30 days, 40 days, 60 days, when we broke 37 trillion. So again, we were $37 trillion debt a few weeks ago. We broke above it. All-time new high, and we're only paying interest. That's a terrible thing. If you want to see something else for a moment, I'll show you this. You ever hear the U.S. debt clock? It breaks down a lot of good detail. So I'll show you one thing here. Just one thing. On the left side. It's updating real time. So if you want to get the data on something, such as the savings per adult or the credit card debt, bankruptcies, a lot of the insight is here. It's not good. Why I say that? Self-explanatory. There's a lot of red. Yes, there's a lot of green, but the red has been growing. See, a lot of these are red. And plus, I showed you here. Red for bankruptcies for business and non-business. That's not good for a healthy economy. I'll show you one more thing. I'll tell you one more thing here. Social Security, that's withheld from your income, your paycheck, and then goes to the U.S. Treasury Department. U.S. Treasury Department invests that money. Yep, U.S. Treasury invested short-term fixed income, and the interest rate on the Social Security, we've been making money. That's a beautiful thing. So again, we have a larger workforce than we have retirees. That's a fact. And as more people are paying into Social Security takes that money and buys U.S. Treasuries to earn interest. We earn a lot of interest. The point is, there's a lot of misinformation coming from representatives past and present in the legislative and executive and other yahoos that ran for office to make misinformation say the Social Security is running dry. The Social Security is going to run out. Easy to make it talking points, but not back it up. Fact, you go to U.S. Treasury website, Social Security Department, see the transactions buying U.S. Treasuries, earning interest. You can also see the unemployment numbers. Enough on that. Let's go back to the charts. I want to show you the 10-year yield on the right. It's the futures market. And a stock ETF on the left called TLT. So each one is a line chart showing 20 years of history. Again, the 10-year yield is very correlated to the mortgages. Look at the top left. Here's the high, 5.15. There's the low, 0.55. And here we are now. It's expected that the yields are going to go lower. The Fed will lower the yields. So this would logically go lower. The stock ETF TLT is an asset you could trade. And when the yields go lower, TLT goes higher. I have bullish positions on TLT. I've been having them on for weeks, months. Advanced option strategies, earning credit income monthly. Yeah, so I've been bearish yields, and I've been trading off of it and earning income. This stock ETF TLT has options on it. Let's go on to the next. So we're going to look at the U.S. Treasury yields. This is a 20-year chart. This is the 30-year yield. Look at the top left, the blue horizontal line, the high of 2004, and all the way to the bottom center, the low of 2020. So the year 2020, yields went higher. You could collect more money on fixed income products. The financial institutions lending you money to make more income on higher interest rates. Well, how we are doing now, show you some insights. Here's the low of last year, 2024. Here's the high, 2023. So we're inside a range. This is us now. This is the 30-year one again, told you. We're inside the range, above 2024, below 2023. And currently for this month, because this month's almost over, making a lower high, lower low, trending down. But we're still above the lows of this year. That's significant. Understand what I just said there. We are still above the lows of this year. We're trending down, but we haven't broken it. The lows of this year. That's the 30-year, the longer duration. Here's the 10-year. Top left, back 2007, bottom 2020. Again, same thing. Here's the high of 2023. Here's the low 2024. So we're inside the range 2023, 2024. And what we did this month, we made a new low for the year. First, I showed you the 30-year. We didn't. So for the 10-year yield, we made a new low. Yep, for the year. So the 10-year yield is more bearish, making lower lows. Where the 30-year has not broken the low of the year yet. These are long-term fixed income. Here's the 5-year yield. Same thing, top left, the high for the past 20 years, the bottom, the low of the past 20 years. Then the 5-year yield. This month, made a new low for the year. You got it? The shorter term, the lower term yields I'm showing you have been making new lows for the year. Not the 30. We haven't, not yet. Not break on the low. And here's a 2-year. Top left, the high for the past 20 years. The bottom, the low for the past 20 years. And this month made a new low for the year. Give you some more understanding of yields. Specifically, the U.S. Treasury yields. U.S. Treasury yields. Who would want to invest in fixed income that pays very little? Or persons that are looking for stability. U.S. Treasury Department, the federal government never defaulted on a loan. Can't say the same for other countries and other nations. So again, safe haven, a lot of people, I told you, other countries, other businesses, other individuals buy U.S. Treasuries, even though they're paying such low yield, but they're more confident in the safety of their nest egg. If we keep yields low, sure, we pay lower interest rate on the debt. That has not discouraged the executive branch, the legislative branch from spending more. I just showed you this current administration is spending more money than the prior knucklehead administration. So again, lower yields has not discouraged them from spending more money and putting that debt on the American citizens. Degenerates in the leadership positions, not good, really bad. Personally, the spending and the debt, neither of the mainstream parties have owned up and taken care of reducing spending, reducing debt. The numbers don't lie. I showed you them. And as long as we keep interest rates low and we can maintain paying just the interest on the debt, why would they be concerned? First, the individual working, you can't print unlimited money. You don't get to tax people. It's much harder. So again, the power of the government, financial assets. Amazing. Let's go take this now to the 10 years. So let's put this 20 years. 20-year history of the US dollar index. Here's the high, 2020 on the top, and on the bottom, the low of 2008. Big difference how the US dollar has been. US dollar index has been making lower lows, lower highs. Central banks. Many nations have central banks. The United States, we have a central bank, but we also call it the Federal Reserve. Typically, when those central banks worldwide lower their yields, it weakens their currency wars. I made many videos about currency wars. It showed real currencies, what's happening. So again, Federal Reserve lowering the yields have reduced the value of the US dollar, having the people that get paid in US dollars less buying power, cost more. That being said, the US dollar is also declining because the confidence. It's still considered a safe haven currency, just like US treasuries. People consider it safe haven currency. They'd rather hold this dollar than many other things. Well, that's another video regarding the metals, what's happening with the metals. Gold, silver, copper. Yeah. So again, declining US dollar, declining yields. Understand, the US has never filled on its obligations. I don't see that occurring for changing anytime soon. But if you want to know, if you don't know, there's rating agencies that have downgraded the US value, confidence, and those will continue eroding. So you could trade and invest in these financial assets. Regardless what happens on the vote tomorrow, the comments they also make on the past and present will give indication of what may be there leaning towards for the last of December. Thank you as always, spending just a little bit of time with me. That's it for the video. Thank you for watching.